Greetings children. Welcome to my channel XI Accountancy by Shakun. Today we'll be talking about Chapter 8 of your TS Garewal, that is Journal. In this video we'll be talking about format of journal, compound journal entries, accounting entries of some specific transactions, and we'll talk about these on the basis of certain examples. First, let us understand the meaning of journal. A journal is a chronological record of financial transactions of a business. So all the business transactions that can be expressed in monetary terms are recorded in a proper sequence as and when they occur in the book of original entry, which is known as journal. For more details on this topic, please refer to my previous videos. You can click on the I button for more details. Moving on. This is the format of journal. Before I proceed to the entries, I would just like to brush it up with you. So we have 5 columns: date, particulars. In the particulars column, you need to write the journal entry. Ledger folio is the page number of ledger book. Debit and credit are the amount columns. Please note that the account to be debited is always followed by the word BR, which indicates that this particular account is to be debited, and the account to be credited is always prefixed with to, followed by a narration, which is a brief description. So all the account to be debited in one line only you have to write under the amount column. Similar you have to follow in case of account to be credited in that line only under credit column. So I have discussed this format in detail in my previous video. You can refer to it by clicking on the I button. Moving on, compound journal entries. Now compound journal entry basically is a journal entry only, but in which more than 2 accounts are affected. See, simple journal entry was the one which we discussed in the previous video. Simple journal entry was the one in which only 2 accounts were affected. One was to be debited and the other was to be credited, and the amounts were equal for both DR and CR. Now the difference is that in case of compound journal entries, more than 2 accounts are affected. So one or more accounts are debited, or one or more accounts are credited, or vice versa. Let us understand this with the help of certain examples. Arjun started business introducing capital of 50,000 in cash and 2 lakh by check. So in this transaction, since I told you about the steps in journalizing, first you need to identify the accounts, then you need to see the nature of accounts, then apply the rule and find out the account to be debited or credited. So in this transaction, the accounts identified are capital, cash and check. Check means bank. Now, since you all know that capital is the account of the proprietor, it is a personal account. Since the proprietor is the giver, we apply the rule of personal account, debit the receiver, credit the giver. Since the proprietor is the giver, therefore capital account is credited. Next we come to cash. Now cash is a real account. Debit what comes in, credit what goes out. Cash is coming in, therefore cash account is debited. Also, the proprietor is bringing in a check worth rupees 2 lakh. So that means bank, being a personal account, being a receiver, should be debited with 2 lakh. Therefore, our entry is cash account DR 50,000, bank account DR 2 lakh, to capital, the total, that is 2 lakh 50,000. So this is a compound journal entry where there are 2 debits and 1 credit. Normally, in simple journal entries, we only had 1 debit and 1 credit. But in these kind of entries, there may be 2 debits and 1 credit, or 1 debit and 2 credits. Let's take another example. Issued a check of 29,000 to Kabir in full settlement of his account of 30,000. Again, when we identify the accounts, these accounts can be identified. First, we can identify check. Check means it is bank account. It's a personal account. We have issued a check. The bank is the giver, therefore credited. Then we identify Kabir. We are issuing a check to Kabir. Kabir being a personal account, being the receiver, is debited. Now this check has been given to Kabir in full settlement of his account of 30,000. 30,000. See, whenever you read the word full settlement, you should know that there is some kind of discount which is there in the question. Now, the amount to be paid to Kabir was 30,000, but we are paying him only 29,000, that too in full settlement, which means in full and final settlement of his account. That means 1,000 is the amount of discount that has been received. Since this is discount received, it's a nominal account. Debit all expenses and losses, credit all incomes and gains. Since it is an income for us, therefore credit. So now we have one debit and two credits. So let's pass the journal entry. So Kabir's account is debited with the full amount that we had to pay to him, that is 30,000, to bank by the amount of check that has been issued, 29,000, to discount received, that is 1,000, which is the amount of discount which we received, which is our income. See, always remember, students generally they make a mistake. They are unable to find out that whether discount is to be debited or credited. They get confused between discount received and discount allowed. So just a simple hint for you to remember that when is the discount to be debited or credited. It is a simple hint, just a trick to remember. Please remember that bank and discount are friends. So they will always be, or even if cash was given here, cash or bank and discount are friends. They will always stay together. So if it is debit, if bank or cash is debited, then discount will be debited. If bank or cash is credited, then discount will be credited. That is a illogical thing, but it is only for helping you to remember the proper treatment. As far as the proper treatment, the logic is concerned, discount is an income, discount received is an income, therefore it is credited. Bank is the giver, therefore it is credited. Kabir is the receiver, therefore it is debited. Moving on, received a check of 29,000 from Sam in full settlement of his account of 30,000. Now we are receiving a check. Since we are receiving a check, our bank is the receiver, therefore debited. Sam is the giver, therefore Sam being a personal account is credited. In full settlement means that we are allowing a discount. Sam had to pay us 30,000, he's paying us only 29,000. That means 1,000 is the amount of discount allowed. It is a nominal account. It is a loss for us, expense for us, therefore debited. Thus our entry will be, since we are receiving a check, bank account will be debited with 29,000. Since discount allowed is a loss for us, therefore 1,000 is debited. And to Sam, the total amount which was due from him. Again, this is a compound journal entry where there are two debits and one credit. And if you notice, bank and discount are together. Moving on, Ramesh, who owed us 10,000, became insolvent and a first and final dividend of 60 paisa in a rupee is received from his official receiver. So, a person becomes insolvent means that he is unable to pay his debts. He does not have enough money to pay all his debts. That means that a person is insolvent. Now Ramesh had to pay us 10,000. He became insolvent, but he could pay us only 60 paisa in a rupee. 60 paisa in a rupee means he could pay us only 60% of the money. So now if again we identify the accounts, we can identify Ramesh. Since Ramesh is a personal account, he is the giver, therefore he should be credited. Whenever you see the word insolvent, it means you have not received certain money which was due from that person. So that means you are going in loss, and that loss is referred to as bad debts. See, this is not a willing discount that we offer. This is forcefully that we are, we have to bear this particular loss. So whenever a person becomes insolvent and there is a resultant loss that you have to bear, it is always debited to bad debts. Bad debts is a nominal account, therefore it is debited because it is a loss. And then you are receiving certain amount from him, 60 paisa in a rupee. So the amount that you receive, that means cash is received, a real account, debit what comes in, so cash is debited. So cash account DR, bad debts account DR, cash is debited because you are receiving it, bad debts is debited because it's a loss to Ramesh the giver. This will be the journal entry. Okay, so the next transaction is goods sold to Satish 30,000, received 10,000 through check at the time of sale and balance to be paid later. Again, the common accounts which you can identify are sales and Satish, but there's another account which is identified, that is check, that means bank. Now, since we are making sales, sales is a nominal account, it always has a CR balance, so sales is credited. Satish is a personal account, he is the receiver, therefore he is debited. And check, that is bank account, being a personal account, is debited because we are receiving a check. Bank is the receiver. So bank is debited with the amount that we have received a check of. Satish is debited with the balance which is yet to be received because of these sales. Satish is our debtor for rupees 20,000 now. Out of 30, he has paid 10, so 20,000, for 20,000 he is a debtor. And two sales, the total sales were 30,000. So moving on, accounting entries of some specific transactions. Now there are certain specific transactions which are a little typical and you need to know that how they are to be journalized. So let's take those examples. First is a debtor whose account was earlier written off as bad debts. See, these are not bad debts, but this is a debtor who must have become insolvent, who was unable to pay the amount, and it was written off as bad debts. Means at the time of insolvency, bad debts account would have been debited. Okay. Now he is paying you 3,000. So maybe his position got better and after a few months he was able to pay you 3,000 rupees. So in that case we have identified two accounts. One is the cash account because you are receiving cash. It's a real account. Therefore it is debited. And second is that since these are the bad debts which are recovered, a new account is created. Bad debts recovered, it's a nominal account, it is an income. We had thought that this is a loss, we had written it off also, but now surprisingly we have received it back, so therefore it is an income, therefore it should be credited. So cash account DR2, bad debts recovered. Please note, do not write two bad debts. You have to write the full account name, that is bad debts recovered, because if you write only bad debts, that is a loss and it should always be debited. Bad debts can never be credited. So if we are crediting an account, that should be bad debts recovered. Moving on, goods given as charity. Now there may be a possibility that a businessman, he wants to give some goods, he wants to donate some goods or wants to give the goods as charity. In that case, two accounts are identified. Goods are going out of the business and he is uh, giving them as charity, which is an expense. So charity or donation being a nominal account, obviously it's an expense, so therefore should be debited. Now what about goods? Normally when the goods go out, we normally call it as sales, that goods are going out, so we have made the sales. But here when the goods are given as charity or when the goods are donated, we do not donate them or we do not give them on charity at the selling price. We are not selling the goods, we are not earning anything from the goods, but although the stock is reducing, so therefore purchase account is credited. Now normally purchase always has a DR balance, but there are few instances, 4-5 cases when purchase account is credited. Now here the purchase account is credited because goods are going out and it is not sales. We are not earning anything out of it. When the goods are given as charity, they are given on cost price, not on the selling price. So on that logic, purchase account is credited. Why credited? Because the stock is decreasing and we have to show it through some account. So that is why we credit purchases account. Please remember, purchase account is always debited, but there are only 4-5 cases where purchase account is credited. Whenever the goods are going out of the business on the cost price, purchase account is credited. So our entry will be charity or donation to purchases account. Moving on, goods given as free samples. Now there is a possibility that the business wants to follow some advertisement technique and wants to give some free samples. You must have seen at times some companies indulging into free samples, giving free samples to the customers to test and to promote their product. So in that case, when the goods are given as free samples, again two accounts are identified, that is goods and free samples. Free samples, when we give, that's a part of our advertisement. So you can write free samples account or advertisement account. It's an expense for us. Therefore, being a nominal account, it is debited. Now coming to goods, goods are going out of the business, but are these sales? No, they are not sales. Therefore, it is reducing the stock of goods. Therefore, purchase account is credited. This is the second instance when purchase account is credited. So our entry can be free samples account DR or advertisement account DR to purchases. Free samples or advertisement is an expense, therefore debited, and purchases is credited because it is reducing our stock. Moving on. Goods withdrawn for personal use. When a proprietor withdraws anything, whether it is goods or cash, for personal use, it means that these are drawings. This you all know. Now, the accounts to be identified are goods and personal use. Personal use means which account is this? Very good. Drawings account. It is a nominal account. It is a loss, therefore debited. Now, goods are going out. Now, will the proprietor earn profit from himself? Will he take the goods from his own business at selling price? No, he won't do that. So the goods are going out and they are going out on cost price. Therefore, purchase account is credited. So drawings account DR to purchases account. Moving on. Now just look at this entry. This entry looks similar to the previous one. The only difference here is instead of withdrawing goods, the proprietor has withdrawn cash. So cash withdrawn for personal use. Again, when you read personal use, you should know these are drawings, nominal account to be debited, and cash is going out. It is a real account, therefore it is credited. So drawings account DR to cash account. Moving on. Loss of stock by fire 20,000 or loss of stock by theft 20,000. Now there may be some instances where the stock which is kept in the godown, it catches fire, or maybe it is stolen by somebody. So in such a situation, there is a loss that the company is suffering. Now two accounts that are identified are the company is suffering a loss and the stock, obviously no matter it is getting destroyed or being stolen, but the stock is reducing. Obviously the level of stock is reducing. So loss of stock by fire or theft being a nominal account, it's a loss. Debit all expenses and losses, therefore it is debited. And stock, now again our stock is reducing, but are we making any profit out of this? No. So whenever you ask such a question to yourself while journalizing a transaction, and if the answer is no, that means instead of sales account or any other account, you have to credit purchases account. So loss by fire or theft account DR to purchases will be the journal entry. Moving on. Now in this case, in case of loss of stock by fire, there are certain other cases attached also. Now if in the question along with that transaction it is written, in case the goods were insured and the insurance claim is lodged. So what happens is there was a loss of stock by fire, but we had got the goods insured and we have lodged the insurance claim. In that case, what will be our entry? Now the loss which we were suffering, the loss which was debited now will be written off. Why it will be written off? Because we will be able to get that compensation from the insurance company. So therefore the loss which was debited in the previous entry now will be credited and insurance company account will be debited. Now why insurance company account is debited? Because it is an asset for us. Why asset? Because we are going to receive the amount of compensation from the insurance company. The benefit will be received in future. Therefore, insurance company account is debited. Now, in case the insurance company is pays the full amount of claim, the full amount is received by the insurance company. Then, in that case, since we are receiving the money, the bank account will be debited. And who's the giver here? The insurance company. Therefore, the insurance company is credited. There may be another case that when the insurance company does not pay the full claim. Now what happens that if suppose we have a loss of 20,000, insurance company was supposed to pay us 20,000. That is the amount for which we had lodged the claim. But out of that, insurance company paid us only 12,000. So bank will be debited with 12 with the amount of claim that is received. Insurance company is credited with 20 because we had created an asset of 20 only in the previous entry. So the amount which has not been received goes to profit and loss account. Since it is a loss, therefore P&L account is debited. Please note, profit and loss account is the account that you prepare in order to ascertain the profit or loss in the business. So this loss will be transferred to that particular account. Moving on, expenses outstanding. Expenses outstanding or the expenses due but not paid. Due means that the expenses, they relate to the current year but they have not been paid due to some reasons. In that case, we will identify the expense account and the outstanding expense account. Okay, now expense being a nominal account, you all know that debit all expenses and losses, so expense will be debited. But an outstanding expense is a liability. Apply the modern approach here. Outstanding expense is a liability, therefore it should be credited. Okay, so when the expense becomes due but is not paid, it means it is an outstanding expense, which is a liability, should be credited. And on the same place, expense should be debited because it relates to the current year. So our entry will be expense account DR2, outstanding expense account. Please note that students generally get confused in this. So please, while passing this entry, you can remember that outstanding expense is credited because it is a liability. So on the other side of the account, you will always write the expense only. You will get to know when I explain the other entry. Prepaid expense or unexpired expense or expense paid in advance, when the expense of the next year is paid in advance. In that case, again the accounts to be identified are expense account and the prepaid expense account. Now prepaid expense, when we are paying the expense of the next year in advance, that means we have to take the benefit out of it. So it is a asset, and assets always have a DR balance. This is an increase in asset and it is always debited. The modern approach. On the other hand, expense. Now expense is credited. Normally expense always has a DR balance, but we have credited it in this case. Why? Because this expense is not relating to the current year. Had it been for the current year, we would have debited it like we did in the previous transaction. But this expense relates to the next year. So therefore, decrease in expense, this amount is credited. So our entry is prepaid expense account DR2 expense. Now, as I was telling you about the hint, prepaid expense is an asset, it should be debited. So on the other side, it will always be the expense. Similarly, in case of outstanding expense, you know it is a liability, it has to be credited. So on the debit side, what will come? Expense. Moving on. Accrued income or income due but not received or earned. Now again, the accounts to be identified are accrued income and income. Now accrued income means the income which relates to the current year but has not been received. Since we have not received this income, it is an asset because we have to receive the benefit out of it. Therefore, being an asset, it is debited. And on the other hand, income being a nominal account, since it relates to the current year, it is credited. So accrued income account DR2, income will be our journal entry. These four entries which I am teaching you right now, they are very, very important. Unearned income, that means the income which is due but received or earned in advance, which is not due but received or earned in advance. So the accounts to be identified are unearned income and income. So unearned income means because we have received in advance, we have to give the benefit to the other party. So it is a liability and hence it should be credited. Unearned income is the income which is received for the next year. So हमें अभी benefit देना है. That is why it is a liability, hence to be credited. And in case of income, normally income has a credit balance. But does this income relate to the current year? No. So that is why we are going to debit it. Why? Because this is a decrease in income. So our entry will be income account DR2 unearned income. Moving on. The depreciation on machinery. This one is easy. Depreciation, you all know, is a decrease in the value of machinery. It is a loss. It is a nominal account. It is a loss. Therefore, it is debited. And the other account identified is machinery. Machinery is an asset, you all know. And this is a decrease in the value of an asset. Assets have a DR balance. Since this is decreasing, so therefore we have credited it. So our entry will be depreciation account DR being a loss, it is debited to machinery account. Why machinery is credited? Because this depreciation is leading to a decrease in the value of machinery. Moving on. Expenditure on installation of machinery rupees 5,000, or it may be written expenditure on construction of building or any other asset for that matter. Now the accounts to be identified are machinery, and obviously the expenditure which you are making is on cash. Now you have to understand one rule, that whenever, please understand carefully, listen carefully, whenever any amount is spent on an asset at the time of purchase, that expenditure is added to the cost of the asset. For example, if we purchase an air conditioner worth rupees 24,000 and spend 4,000 on its installation, so that means the amount of our air conditioner, the value of our air conditioner will be 28,000. Similarly, if we purchased a machinery, the purchase of machinery has not been given here, but if we purchase a machinery and on its installation we are spending 5,000, that means the amount should be added to the cost of machinery. Machinery being an asset should be debited, so machinery account is debited, and we are making a payment, cash is going out, so therefore cash account is credited. So please always remember that whenever any amount is incurred at the time of purchase of an asset, it is always added to the cost of the asset. So in this video, we have talked about the format of journal, just to brush up. Compound journal entries, where there are more than two accounts that are affected, two debits and one credit, or one debit and two credits. We also talked about certain accounting entries of some specific transactions which were very important, such as bad debts, outstanding expenses, prepaid expenses, bad debts recovered, unearned income, accrued income, etc. All these transactions which I just told you, these are very, very important transactions. So I hope the concept was clear to you. If you liked my content, like my video, show some love, subscribe to my channel. You can hit the bell button in case you want to get notified, and any queries that you have, please email me on my email ID or leave a comment in the comment section below. Thank you so much for listening to me so patiently.